Okay, this is brief exercise 5-4. It's found on page 224 of your textbook. BE 5-4 is the other side of what we saw in BE 5-3. In BE 5-3, it was looking at the journal entries for the seller, which was Monroe Company. Now we're going to look at those exact same transactions, but in the viewpoint of the buyer, and the buyer, the purchaser, being Churchill Company. So we're going to record those business transactions under the perpetual method, perpetual inventory system for Churchill Companies on Churchill Company's books, and Churchill Company is the buyer, is the purchaser. All right, in the first entry in transaction A, March 2nd, Monroe Company sold $900,000 of merchandise to Churchill Company. That's really all we need to know. As the buyer, we're going to record that inventory coming in. So we're going to debit our inventory. This is different than as a seller. As a seller, you would make two entries there. As the purchaser, as the buyer, you're just concerned with that, what it cost you, that sales price, and you're going to put that in your inventory. Whoa, it went off the screen there. Let's head back down. Okay, so we're going to debit our inventory account for 900,000 and we'll credit accounts payable for 900,000. Because we'll owe Monroe Company the 900,000. So we're going to record, we're going to reflect that in our books, that we have this accounts payable due to Monroe Company for the 900,000. Remember now, we're Churchill Company now, and we're the purchaser. So I'm going to record this inventory that we received. All right, let's see transaction B. On March 6th, Churchill Company returned 120,000 of the merchandise. All right, so as Churchill Company, we returned part of the merchandise. I'm just going to reverse the entry I made in A. I don't owe Monroe Company $120 of items that I return, right? So I want to take that off my books. I'm going to debit accounts payable for the 120,000, which was the sales price of those goods, which is my cost. And here's my merchandise inventory. I'm going to reduce my inventory for the amount of the items that I returned back to Monroe. So in effect, you're just reversing the entry that you made in A, but for the amount that you returned. Okay, you purchased $900,000 worth, and you're returning $120,000 worth. Okay, let's look at C. On March 12th, Monroe Company received the balance due from Churchill Company. So as Churchill, we took advantage of that sales discount. And so we want to reflect that. As the buyer, that discount, that purchase discount for us, because we're paying timely, that's a reduction in our inventory. Our inventory doesn't cost so much anymore. Okay, so remember that. If I was the seller and you're talking about a sales discount that we're giving a customer, you're going to record that as sales discount. As the purchaser, on the other hand, if I'm taking advantage of a discount and I'm paying on time to get that discount, then I want to reflect that as part of my inventory, a reduction in my inventory. So let's take this a step at a time. Let's see first, what do we owe Monroe Company? Let's look at our accounts payable. All right, so we originally owed them 900,000. We're going to reduce that by what we returned, the items we returned of 120,000. So our accounts payable is only 780,000. That's what we owe Monroe Company. So let me debit that. Let me just do this a step at a time and take care of that entry first. So I'll debit my accounts payable. I'm going to remove that off my books because I'm going to pay Monroe Company now. And there's how I calculated the 780, right? We're going to take the 900,000 minus the 120, and that's our current accounts payable balance to Monroe Company. Okay, so from that 780,000, I want to calculate the purchase discount, and I can take 2%. So I'm going to take that discount, and what I will do is credit my inventory. My inventory will be worth actually less. It cost me less because I took advantage of that inventory. That's a good thing. You want the cost of your inventory to be minimal, so you'll have a greater gross profit. Sales minus your cost of your goods. So here's my merchandise inventory, and I'm taking that discount, right? I'm crediting my inventory account for that purchase discount that I'm taking, the 15,600. Again, as the purchaser, when you take a discount, you're going to affect your inventory account. As the seller, when you grant a discount to the buyer, you're going to record that as a sales discount. Two different views of the same item. All right, then my cash will be less. I'm only going to pay Monroe Company for the difference, right? If we look at this here, in my entry, my debits have to equal my credits. Well, I need another amount here, right, for this to balance. I need 764,400. What am I crediting? Well, we're paying cash, right? We're paying what we owe to Monroe Company. And there's the cash. And you figure that amount by just taking the difference between your accounts payable less the discount that you're taking. So remember that. You can just easily record the accounts payable that you're removing from your books, and then record the cash that you're going to pay out, which will be the accounts payable less that discount that you're taking. And then the difference will be the discount, and that's what you want to reduce your inventory by. All right, that was it for problem BE5-4, and that's giving you both sides. That's very similar to that chart that I had put on the board, the buyer versus the seller, which also I had put out on Ocean Cruiser for you. So when you're doing these type of problems for homework, you can have that in front of you and you can get it straight. You can see the contrast and the similarities with being a purchaser and with being a seller. So in BE5-3, we were the seller. In BE5-4, we're the purchaser. All right, that's it for these two problems.